Okay, so we're on the bit of the cost of sales, but a quick review of what we've discussed so far. So, dear professors, if you are asked to state the three, or let me ask, oh, I've even answered myself. Well, if you're asked to state the final account of a sole trader, then what would be your answer? Quickly. Prof, I say, oh, I think her microphone is not connected. Okay, so I think I'll do it. So we have the trading account, the profit and loss account, and the balance sheet. These are the three. The trading profit and loss account is known as the income statement, and the balance sheet is known as statement of financial position. Now we pick the trading account. However, I drew the distinction between the service proprietors and the trading proprietors, right? The trading proprietors are those who are doing the buying and selling of goods, and for them, we prepare the trading account. But for the service businesses, we don't prepare trading account for them, right? Because they are not buying and selling any goods. They are only rendering services. Okay. So please get that clear. So in case you are asked to state the final account of a service business, okay, or a sole proprietor who is rendering services, then you are not supposed to write the trading account. You can state the income statement and the balance sheet, or the profit and loss account and the balance sheet. Make sure you don't add the trading account. Thank you very much. We picked the trading account and we saw that this account is prepared solely to determine the profit or loss a trader is making from his or her buying and selling of goods or merchandise. We saw that in this account, you compare two things. You compare two things, your net sales and your cost of sales. The net sales we have seen to be your total sales minus any return inwards. We are on the cost of sales, which I explained to you that it refers to all the costs incurred in getting the goods ready for sale. And to be able to get your cost of sales, you need the following. One is the opening stock. Professors, any idea as to what opening stock refers to? And I think, Prof. Frank, will need your expertise here since you have gone through the topic to some extent. So, Prof. Frank, can you tell us about opening stock?
The opening stock are the goods available at the beginning of a financial year or period.
Perfecto. That is great. So, the stock of goods that is available at the beginning, so opening, beginning, or at the start of the year or the period is the opening stock. The second one is purchases. Well, I believe my professors know purchases. Goods bought with the intention to resell them, right? If you buy an item and you have the intention to sell it, then that is purchases. Okay. If the intention is not to sell it, but to use it in the business, that's where we look at the asset, right? That's why when you buy a vehicle, it's termed as an asset because the intention is not to resell it, but to use it in the business. Okay, so always note that your purchases refers to goods bought or goods meant for resale. Okay, so if you are not reselling it, then it qualifies to be an asset. Right? Having said this, let me ask a question. If I'm a car dealer, okay, I buy and sell cars. If I'm a car dealer and I buy a car, but the intention is to use it in the business, would that be referred to as purchases? I'm a car dealer, so I buy and sell cars, but I buy this particular car or vehicle and the intention is I want to use it in the business. It is not meant for resale. Would that be purchases or not? Please, I want you to share your thought on that. Sandra, can you do that?
So I don't think to be purchases.
Okay, so Sandra says it's not purchases. And I think that's the point because it is not meant for resale, right? Good. So we all know purchases. Return outwards. Return outwards. I want to believe professors appreciate return outwards. The goods that the business will return back to its suppliers. So if we go and buy, say, shoes from Melcom to sell, then we'll go and buy 100 shoes. We wanted the color white, but we saw one of them was black. If we return that black shoe back to Melcom, that is return outwards. So return outwards is associated with purchases. When you purchase and you return back to the supplier, that's return outwards. Carriage inwards, as you know, refers to the cost incurred in transporting the goods you have purchased to your shop. Okay, so if we buy the shoes from Melcom and maybe our shop is in Wesley Girls campus, the cost we incur from carrying the shoes to Wesley Girls, that's carriage inwards. Okay, now closing stock, I think you can define closing stock if you know what opening stock is. That will be the stock of goods available at the end or at the close of the year. Then direct trading expenses. These are expenses that are incurred directly to ensure that the goods are ready for sale. And a typical example is wages. And I want to believe professors appreciate wages. The remuneration paid to someone for rendering a service instantly. Okay, wages are paid at the end of the work. So you work for me, I pay you, that's a wage. Unlike salary, which is payable maybe at the end of the month. Salaries are actually paid annually, but we can't wait for 12 months before we pay the person. So we divide it into a monthly basis and we pay the person. Okay. So wages are more direct than salaries. So take note of that. Good. The wage is paid immediately after the work is completed. So it's directly related to the work. If you don't do the work, you don't get the wage. So until you do the work, you get the wage. But for salary, sometimes you might not be doing the work, but at the end of the month, you get your pay. Of course, it might not be due to your own making, right? Okay, so these are the items you need to, use to get your cost of sales. Now, how do you get the cost of sales? And I'll take my professors through it beautifully. The first thing on the list is your opening stock. If you want to know the cost of the goods you have sold, you need your opening stock. So if you own a grocery shop, okay, if you own a grocery shop, what you know as a provision store, and let's say you are now in the year 2025, 2025, at least some of the provisions might be in your shop from 2024. So at the beginning of 2025, all the goods you have already in your shop is the opening stock. So you pick that one, right? And then you add, maybe in the shop from 2024, we had maybe 10 books, 5 sardines, 3 pens. That will not be enough. So we go to the suppliers and we purchase more. Okay. So you have to add the purchases to your opening stock. Let me use this to make my professors appreciate. If you have, let's say, your mother cooked jollof rice yesterday, and there was a small portion left. This morning, that small portion left will become the opening jollof, opening wachi, or sorry, opening jollof, right? Opening stock of jollof. Now, if it is not enough, you can go to the market and buy or purchase more jollof. Okay. Now, what do? You will add what you have gone to the market to buy to what you already had from yesterday. So it makes sense to say you add your opening stock to your purchases. But the purchases need to be adjusted with these two items: return outwards and carriage inwards. Because when you go and purchase, there's a possibility that you asked for waakye, but the woman gave you, so you asked for jollof, but the woman gave you waakye. You definitely have to return it back to um, the seller. Or she gave you waakye 5 cedis, jollof 5 cedis, but you were looking for jollof 10 cedis. So you return the waakye 5 cedis, right? So that's return outwards. So you normally less the return outwards from your purchases. And then the carriage inwards. This is the cost you incurred from carrying the goods to your shop. You need to add it. Okay. So if I'm continuing, your opening stock, you add your purchases, then the purchases you less return outwards. Okay. And then you add your carriage inwards. Okay, I wish I can put it in an equation form for it, but that will be seen in the format. Okay, so you just follow. But I want to believe my professors appreciate it now. So your opening stock, you add your purchases, but the purchases, you adjust these two items. Normally, when you adjust these two items, what you get is called net purchases. So it's your net purchases added to your opening stock. Now, let me quickly take you to the format so that maybe you begin to appreciate how these things are done in there. So the first element we saw, the net sales, this is how it is arranged in the format. The format begins with the title, trading account for the year ended. That is added because we prepare the financial statement or account for 1 year, 12 months. Okay, so if the year is ending 31st December 2024, you put in the date there. Some of the years might end on any other date. The question will give that to you, so you don't have to stress your head over that. Okay. After that, you see what is happening here. You leave one or the first column to write the name of the items. Then you leave 3 columns for your figures or your amounts. Right? So 1, 2, 3. To get your net sales, which we saw is the first thing you have to look for, you bring your total sales and then you less the return inwards, and you get your net sales. Now for the cost of sales, you remember I just told you that you start with your opening stock and then you add your net purchases. So look at it. But the net purchases is determined by lessing your return outwards and adding your carriage inwards. And I've given you examples to explain why. If you go and buy, say, 1,000 exercise books from your supplier, so you purchase 1,000 exercise books from your supplier. If you return 50 of the books back to the supplier, then it makes sense to say, okay, I bought 1,000, but I've returned, how many did I say? Is it 50? I've returned 50 back to the supplier, right? So I no more have 1,000, I have 950. So that will form the basis of your net purchases. And then the cost you incurred from carrying the goods to your shop, that carriage inwards, you have to add it to the cost of your purchases. And that will give you your net purchases. So it's your opening stock plus your net purchases. That gives you the cost of goods available for sale. So the example I gave with the jollof, you had small jollof from yesterday, which becomes the opening jollof for today. You add it to the jollof you have gone to purchase. And when you add it to it, what you get is total jollof available to chop or eat. So when you add your opening stock to your net purchases, you arrive at the cost of goods available for sale. Because that is the goods that becomes available to sell to your customers. Please, any question? No question. Great. When you get the cost of goods available, the next thing you do is to less closing stock, or you deduct your closing stock. Why are we deducting the closing stock? We do that because we want to know the total cost of goods we have actually sold. So let me use the jollof scenario again since it makes sense. So there's a small portion from yesterday, which is the opening stock or jollof. You add what you want to purchase and you get the jollof available to eat. If after eating you are not able to eat all, there was small left. That small left is the closing stock. So if you want to know the exact jollof you have eaten into your stomach, then it makes sense to say, okay, I had this bowl of jollof available, but I couldn't finish this. So you less it from it and you know exactly how much jollof has gone into your system. So the same idea here. Let's say you had 1,000 goods available to sell to your customers in your shop. At the end of the year, you couldn't sell, let's say, 600. So when you do the math, you know that, okay, I had 1,000. I have not been able to sell 600. If I less that from the 1,000, I'll get 400. And the 400 becomes the goods that I've actually sold. Okay, so you always less your closing stock to get your cost of goods sold. Then finally, you add all the direct expenses you incurred through your trading. And that will give you your total cost of sales. Your total cost of sales. When you get the total cost of sales, you remember I said you are comparing two things, net sales and cost of sales. So the difference between the two give you the profit or loss, specifically gross profit or gross loss. I think I have to pause for questions and reactions from my professors. Any question, professors?
No, please.
Okay, great. So it is important for you to take note of certain key terms, right? You can be asked to briefly explain net sales, briefly explain net purchases, briefly explain cost of goods available for sale, or cost of goods sold. So if you are asked to explain net sales, you tell us is the difference between your sales and return invoice, or is sales less return invoice? If you are asked to explain net purchases, your net purchases is your total purchases less return outwards or minus return outwards plus carriage inwards. Okay, so no distance, they are examinable. If you are asked to explain cost of goods available for sale, that is equal to your opening stock plus your net purchases. And your cost of goods sold is your cost of goods available minus or less any closing stock. So I think I jot down some of these things here. Now, the format we saw is the vertical format, right? There is a horizontal format. It's gradually going into extinct, so we don't normally pay attention to it. When we get familiar with the vertical format, I would introduce the horizontal format. So these are some of the things that you need to note: opening stock, closing stock, net sales, net purchases, cost of goods available for sale, cost of goods sold, and gross profit. So this is your trading account, right? Now, I don't want to bore my professors with a lot of talking, so we'll pick a small example and see how best we can prepare our trading account.